So welcome to this video. We'll begin by taking about accounting in the business environment. So we'll start with some simple accounting terms that you need to know and build upon. So the first thing we all talk about is accounting. Accounting is the language of business and measures business activities, process data into reports, and communicate results to decision makers. Financial terms, financial statements are reports on a business in monetary terms. So these are probably all terms that you have familiar with, but now you have a more solidified definition of what these terms mean. There are four financial statements. The first statement that you need to prepare is an income statement. The income statement will show us what our revenues and our expenses are, and then from those statements able to calculate what's called net income. The second statement will be preparing will be the statement of retained earnings. This statement simply shows us what the change in our retained earnings are of a period of time. So from how did we go from our beginning retained earnings to our ending retained earnings? The third financial statement is the balance sheet. The balance sheet shows us our financial position as of a specific day in time, and the fourth financial statement is the statement of cash flows. And there are three sections of this statement that we need to be familiar with, and we'll be looking at those later. There are two types of accounting. The first type is financial accounting. So we produce those financial statements or those reports that provide information to users outside of the company to assist them in decision making. For example, an investor need to know your financial information to be able to make an informed decision as to whether want to invest in your company or not. The second form of accounting is managerial or management accounting. This type of accounting information provides information to users inside the company to assist in decision making. So now we'll talk about users of these specific types of accounting information. The first one is financial accounting information. Users of this type would be creditors, people lending you money or a company money. They would need to know how financially secure are you for me to be able to lend your money. The second would be investors, which we mentioned before. As investors, should I invest in this company? Am I going to get a good return? Are the financially stable? A third user would be the government. For example, the IRS. Users of manager or management accounting would be management. They would take this managerial accounting information and make decision for the future of the business. Where do we go from here? So just to use a diagram of what we just talk about in decision makings or making decisions. Insiders. Users of managerial accounting make decisions for a company. Where are we going to go from here? Outsiders that use financial accounting information will make decisions about a company. So what should I do in regards to this particular company? A few more concepts and principles that we need to behave a firm foundation with a GAP. GAP stands for Generally Accepted Accounting Principles, and GAP tells us what information must be three things. Useful information must be relevant, it must be reliable, and it must be comparable. So the information that we are given as investors, for example, The information needs to be relevant. Is it relevant for me to be able to make a decision? Is it reliable information? And again we'll be taking about these in more detail. Is reliable. How reliable is the information? Do you have a document stating that what you paid for this item, or is it just a number you made up? For information comparable, so we are given these methods. For example, inventory valuation methods that were allowed to use. That way an investor can look at two companies that are keeping their financial records and say, okay, I know they are following a certain set of rules, therefore these companies are comparable. In this lesson, we learn about objectives of the accounting. Accounting helps organization in achieving their goals by recording, summarizing, and presenting accurate financial information to its users. Following are the 11 objectives of accounting that demonstrate the importance of accounting systems in organizations. Number 1, recording. It is a reliable accounting record forms the backbone of an accounting information system. The fundamental objective of accounting is to maintain a systematic, accurate, and permanent record of all transactions of a business, such as sales, purchases, income, and expenses. Number 2, planning. Accounting enables organizations to plan the use of its limited resources, such as cash and labor. By preparing budgeting process helps of organization to plan ahead by anticipating future business needs and identifying potential bottlenecks, but it's improve the efficiency of organizations by diverting resources to the most critical business process. Next, number 3, management decisions. Management decisions. Accounting information helps managers in evaluating a range of decisions to improve the profitability and efficiency of business, such as pricing decisions, limiting factor analysis, financing decisions, and investment appraisal. Number 4, performance measurement. Accounting helps to determine how well a business is performing by summarizing the financial information into quantifiable measures such as sales, revenue, net profit, expenses, and so on. It is important for organizations to measure their key performance indicators regularly and reliably so they could improve themselves by making valid comparisons against their past performance as well as against industry benchmarks. Number 5, position analysis. Financial statements indicate the financial conditions of a business by showing, for the example, cash flows, capital investment, cumulative earnings, and liabilities and assets. Next one is liquidity assessment. Number 6, liquidity assessment. Mismanagement of cash flow is often cited as the primary reason for failure. In many startups, accounting helps businesses in reducing the risk of bankruptcy through timely detection of financial bottlenecks and managing cash flow in a way that the business always has sufficient liquid funds available to pay for its financial commitments. Number 7, financing. So here, financing. Organizations that are low on funds need to present their accounting information to lenders in order to secure finance, whether a business applies for a loan or an investment by shareholders. You will need to provide its historical accounting record as well as financial plans, projections, and forecast it. Number 8. Internal control. One of the key objective of an accounting system is internal control, and this places internal controls within an organization for protecting its valuable resources. Assets of a business such as cash buildings and inventory are also susceptible to losses arising from theft, fraud, error, obsolescence, damage, and mismatch. Accounting information system should ensure that such risks are reduced to an acceptable level by placing various check across organizations. Number 9. Accountability. Accounting provides a basis for assessing the performance of a business over a period of time, which facilitates accountability across several tiers of an organization. Number 10. Legal compliance. The legal compliance accounting facilitates organizations in performing their legal responsibilities by providing accurate information of their financial rights and obligations. Accounting is also a legal requirement for most businesses. Law requires organizations to maintain an accurate accounting record and to report their financial results to stakeholders such as tax authorities, shareholders, and regulators on a timely basis. Number 11, this is the final one. The here user's role. Accounting is not just limited to the information needs for of employees and owners of a business. Accounting fulfills the information needs of a diverse group of stakeholders. In this lesson, we'll learn about users of accounting information. Accounting helps users in making better financial decisions, but you may be wondering, who are the users of accounting and what information do the users need? Users of accounting are both internal and external to the organization. Internal users include owners, managers, and employees of the business. Owners need to know how well their business is performing. Owner assesses the profitability and risk of their business from financial statements. Managers require accounting information to prepare budgets that specify the organization plans to use its limited resources. Managers also need accounting information to monitor the performance of the organization and to make business decisions. Employees are interested in knowing how well a company is performing, as it could have implications for their job security and income. Employees working in the finance department prepare, summarize, and present accounting information for other users. External users. External users of accounting include investors, lenders, suppliers, customers, tax authorities, government, auditors, and public. Investors need to know how well their investment is performing. Investors rely on financial statements to assess the profitability of risk and worth its investment. Lenders and suppliers accounting information of their clients to assess their credit worthiness. And next one, customers. Industrial customers need accounting information of suppliers to assess their ability to deliver goods and services on a reliable basis in the future. Tax authorities review accounting information of business to determine whether they declared the correct amount of tax in their tax returns. Regulatory agencies of government review accounting information of organizations to monitor compliance with accounting and financial regulations. Auditors inspect the financial statements and accounting records of organizations to determine their accuracy. General public may also be interested in the accounting information of a company. This could include journalists, analysts, academics, and activities and other individuals with an interest in economic developments.